Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim, and happy holidays.
Thank you, Jim, and happy holidays to you and our listeners.
Taking a look over the year, gold, did it perform the way we expected it to?
It performed pretty well the way I expected it to, in the sense that it really wasn't a bullish year. You know, we had an annual cycle low back in December. That cycle peaked in September, and we're well off of those highs. We've a couple of weeks ago, or well, actually just a few days ago, it was on the 12th, December 12th. We had a short-term cycle low, and I think it was an intermediate degree low as well. And you know, we knew going into that low that that's what we were facing, and that it should be another counter trend bounce here. And you know, ideally, we should have seen. I say should. That was the expectation, is that we would see that 9-year cycle low later this year. Well, we've run out of year, and we did not get the 9-year cycle low. So from that perspective, no, gold did not perform exactly as anticipated. Did it blast to the moon? No, it did not. So in that respect, it did perform as anticipated. What's going on with gold is we saw the annual cycle advance out of the December 16 low into the September high. You know, it took longer than anticipated for that advance to conclude. So it's extended this 9-year cycle just a little bit. What I think we're facing now is one of two things. I think that, like I said, that we've got the intermediate degree low here in December, and that we got another counter trend bounce on our hands, that it should fail, set up once the counter trend bounce is over, and then that's our number one expectation, is that then that should lead to that final push down, which is going to take us into early, next year. Probably it's looking like maybe February, March-ish, that we're going to extend by one intermediate term cycle, and that we get the final push down into that 9-year cycle low there. If that doesn't happen, then number two, then it will be time to reevaluate. Did we see the 9-year cycle low? And so that will, in all fairness, have to be addressed. And if we did, it would have been back in 15. And if we did, before people get too bullish about that, then this is a pretty pathetic 9-year cycle advance. So, you better hope at this point that wasn't the 9-year cycle low. I mean, it's pretty pathetic if it was. So I still think, in summary, like I said, we're at an intermediate degree low. I think this is another bounce that's going to take us to where we want to be. And then I'm very bullish on gold, if we can see that statistic remain whole. Looking at the gold stocks, it's pretty much the same. The difference there is we had that back in December of 16, we had that annual degree cycle low, but it topped in February. There was a secondary high in September, but the actual top occurred in February. So that left us with what you would call a left translated cycle. And as with gold, we saw a low here a couple of weeks ago, a week or so ago, in December 12th, of short and intermediate degree, and we have another intermediate counter trend bounce underway. But because of that left translated cycle, it hasn't been fulfilled yet. So that too, the structure there also tells us that we should see that final push down into, the 9-year cycle low in gold and, silver, of course, and the gold stocks, metal stocks, I should say. So the structure there is confirming the overall expectation. So, I think we're on track there. looking at crude oil, we had a 3-year cycle low back in January of 16. We had a little annual, I call it a seasonal cycle low, annual cycle low, whatever, in mid-June. That's somewhat counter-cyclical, if you will, from a seasonality perspective. Usually you have the highs in the summer and the lows in the winter, and this has kind of been upside down. And why I don't know, but it is what it is. But we had that intermediate term or annual cycle low in June, and now that cycle is trying to peak. It's been trying to peak for, I guess, about 6 weeks in crude oil, and it's just kind of back and forth as that top is trying to build. So I think that's where we are there, that it's setting up for like I said, that top, and then it'll be positioned to go down as well. When we look at the CRB index, which is, a basket of commodities, we also had the 3-year cycle low back in January of 16. We have an intermediate degree. Well, let me back up one step. We had the annual cycle in June of this year, week of June 22nd. And then we've seen a high in November. And at this point, it looks like the intermediate degree top, counter trend advance, intermediate degree top, one and the same, is in place in the CRB index. And so what the picture, if you knit these pictures together, what we're seeing in gold with the counter trend advance and the 9-year cycle low still lying ahead, when you look at oil and the fact that we had the annual cycle low in June, and that it's trying to make a top, and then you look at the CRB of, the cyclical structure is pretty much the same. And so what it's telling us is that the entire commodity complex does appear to be trying to peak, and that it should turn down into some higher degree lows. So in that respect, yes, everything looks to be on track. Has it taken a little longer than anticipated? Yes, it has. I would have expected the top in crude oil to have occurred before now, and I would have ideally expected the washout in gold to have already occurred. But because of that, a little bit of an extension of the annual cycle, then it's extended a little bit. It is what it is. But the overall expectation still looks like it's on track.
We'll have more with Tim Cyclesman Wood right after the break.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Welcome back. We're talking with Tim Cyclesman Wood. Tim, the equity markets, both in Canada and the U.S., had a very exciting year when people predicted before President Trump was elected that the markets would have a huge downturn. What was the difference, and why was there so much optimism on the markets?
I don't know what the difference was. It still amazes me how the market was down. I remember seeing it down 700-800 points the night of the election. And then the next morning, all of a sudden, the negative become a positive, and the market was up and has been up ever since. Throughout the year, we have seen, on one hand, while the market, it has been a phenomenal year for the market, but on the other hand, we have seen the market struggle. I've lost count of how many little short-term Dow 39 confirmations we had along the way. We have the checklist of the DNA markers. And nothing ever solidified, but we would have a couple of them fall in place. The market would be on the edge, and then they'd morph away, and the market would push higher. And the last occurrence going in, I don't remember from interview to interview what we really talked about, but I assume we talked about this in the last interview. You know, going into mid-December or mid-November, this market was literally on the edge. I mean, we had the initial markers in place, and it was ready to take the step off the cliff, and then poof, it morphed away again, and the can gets kicked down the road, and up we go. So, you know, in that perspective, you know, nothing has solidified, and therefore the market has gone higher. From the other perspective, you know, equities, it is a tremendously extended stretch. I know it's the same old story, but it is what it is. Bubble. When you look at some of the other indexes and sectors, such as, if you look at and I'm not making excuses for the market, I'm just telling you that when you look at the actual structure here, it tells you something. You can't ignore this. I think it is somewhat of a roadmap, or paints the environment in which we're in. It shows the anomaly, if you will, that we're seeing with more of the mainstream averages. But it's a historical fact. If you look at, for example, the American Stock Exchange index, I mean, I'm looking at the chart now. You know, it peaked in March of 2000 with the 4-year cycle low. It bottomed in 2002, just right along with everything else. It peaked in November of 2007. It crashed with everything else into a low. In that case, it bottomed in October of 2008 versus March 2009 for the industrials. It peaked, you know, looking at the extended 4-year cycle, it peaked in 2014, whereas the industrials peaked in 2015. And then it made a low, a 4-year cycle low in January of 2016 versus August on the industrials. It was August of 15. So they ebb and flow. The cycle, that longer term 4-year cycle, is the same. It's there. And it's there on you know, all of these equity averages pretty much. And if you look at the American Stock Exchange, what you see is that it has not bettered its previous 4-year cycle high like the industrials have. It has not bettered its 2014 high. You know, nobody's looking at that. It's just kind of a silent little indicator that's back there, a little warning that's back there. And now, you know, it looks like that it's in trouble. I mean, it looks like we could have a failed cycle trying to take root there. When you look at the Russian index, there's also some warnings there. When you look, I've talked, you know, all year about the Tel Aviv. The Tel Aviv index is sick. I mean, the structure of it broke below its previous 4-year cycle low. And so I'm not saying those things to try to justify or minimize the rally that we've seen this year. The rally we've seen this year has been phenomenal, but it has been in the face of, you know, these warning signs from the other averages, indexes, and it has occurred. Like I said, it has blown out. I say blown out. That may even be a strong word, but we have seen several setups try to form, and it has blown them out before they ever, you know, solidly solidified with the Dow theory primary bearish trend change. And so I think what I'm saying and trying to say in summary is that yes, the advance is very much still intact. I have no indications of a higher degree top as of this interview. I do think that there is a intermediate, and in my world I call it the seasonal cycle, annual cycle top due now. Once we get a short-term sell signal, I suspect that it should evolve into those higher degree tops, but I don't see, because of the lack of the markers going into this intermediate and annual degree top, I don't see it being a significant top yet. But I say that in the context of, heck yes, it's still, I think, no question about it, the bubble that we've talked about all year. It's just not set up yet. It's just not there. And I think we have to see that set up. Once we do, you know, I don't know if it occurs in a month or 6 months or if it's 2 years down the road. We'll see it when it happens. But once it does, you know, I do think there is a tremendous unwinding coming. And what I'm trying to say is that, yeah, when you look at the industrials or the S&P or, you know, most other mainstream averages, you don't see those warnings. And so, yes, they look good, and yes, they've blown out and kicked the can down the road numerous times this year and made every technician on the planet look like a fool. But at the same time, you cannot ignore You can't all of a sudden say, well, these markets have cyclically ebbed and flowed with these other indexes and averages all throughout history, and now all of a sudden that's different, and you know, the industrials no longer rhyme with the American Stock Exchange. The industrials no longer rhyme with, you know, the Tel Aviv exchange and you know, some of the other ones. So there are some warnings. We're not there yet. So that's what we're looking for. We've been looking for it all year. It never materialized, but once we get the DNA markers in place and it's solidified by a Dow theory primary bearish trend change, I think you know, you know, who knows what could happen. We have a tremendous unwinding from this bubble that's been created, but for now, it is what it is.
We'll have more with Tim Wood right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Tim Cyclesman Wood. Tim, the U.S. looks like it's going to approve its tax cuts and changes, and the trickle down maybe has happened, unlike the last time they had major tax cuts. Big banks announcing that they're giving out $1,000 bonuses or that they're boosting the wages of their lowest paid employees. Is that the kind of thing people expected to happen from these tax cuts? That perhaps this is the nice little boost to the U.S. economy that it could greatly need?
You know, I don't know what people expected from the tax cut. Honestly, I didn't think anything would pass myself, but it looks like it has. I was looking at some stuff this morning. You know, the media gets a hold of everything and spins it, and I saw a real good breakdown, and I actually Googled it and looked at the tax rates. And from what I can tell, you know, everybody says, well, it benefits the rich most and this sort of thing, doesn't do anything to the little guy. Well, not according to what I saw. Looking at the tax brackets, I mean, they went down. Looking at the personal exemption, and that went up. And so it is going to give a universal break across all tax brackets. And of course, the more money you make, then obviously the more benefit you're going to get proportionally. So it does look like a legitimate tax break. How that stimulates the economy, I don't really know. I mean, maybe this is a buy the rumor, sell the fact type thing. I don't know. I guess time will tell. And like I said, from a technical perspective, all that matters, we know the environment we're operating in. We know that this is the most extended, most overvalued market in U.S. history. We know that. That's an undeniable fact. But until it sets up, and I don't mean it's like a broken record, that's all that matters. Until we get the setup with the proper markers and a Dow theory primary bearish trend change, you know, this thing's going to go on and on and on and on. There's been many, many warnings along the way, but nothing has stuck. So that's where we're at. Now, what I think may happen is that we could see if commodities do continue to unfold in accordance with, the expectations and the way they seem to be unfolding at this point, then it may be that we see everything set up and collapse together. That's kind of been my thinking all along. It's just taking a whole heck of a lot longer than anticipated for that to happen. On the other hand, maybe the commodity setup that is, so far appears to be on track, maybe it's derailed. Maybe it doesn't. And this ends up, extending, the bubble goes on, far longer than ever imagined, which I guess it's already done that, but you know what I'm saying.
Tim, thank you so much for all your help over the year. And I hope you and your family have a great Christmas and a Happy New Year.
Thank you. And same to you and our listeners. I appreciate you having me on all year, and I look forward to another year.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Questions for the show can be sent to info@HowStreet.com. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Happy holidays, everybody.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.